Good morning and welcome. Today is Thursday, October 12th, 2023, and here I am again, except this is now the entrance to Central Park. 59th Street is on the other side. I figured maybe this was a better look this morning, and welcome. I am Kenny Polcari, your host of the party, and what is it that you need to know today, right? So here's what you need to know. CPI is only moments away. Now remember, yesterday's PPI was hotter than expected and stickier, right? Showing that not only is inflation hotter, but apparently stickier. The Fed minutes, though, at 2 o'clock, they revealed a straight split right down the middle, and investors are piling in to the safety trade thing, bonds and gold, right? Delta Airlines joins Pepsi this morning and reports better than expected earnings. Hello, anyone listening? Listen, this morning gold is up, oil is up, the dollar is down. And what are we having for dinner tonight? Well, it's a little bit tangy and spicy, so we're going to try the Puttanesca. Okay, listen, the day began yesterday when the government reported the September PPI, and while it was expected to be hot, it was actually hotter than even the already elevated expectation. So that's an issue, right? The PPI month over month came in at plus 0.3% versus the expected up 0.2. Expectations year over year, though, came in at plus 2.2% versus the expected 1.6 expectation. And when you take out the volatile food and energy, the year over year number came in at plus 2.7% versus the plus 2.3%, which is 17% higher than the expectation. In addition, they also revised last month's year over year number upwards. So that's an issue as well. And then at 2 p.m., the Fed released their minutes from the latest meeting, right? And that revealed that there's a split right down the middle over what to do next. Were they prepared to raise rates again or not? Were they prepared to hold them higher for longer or not? Those are all the questions that investors want to know. Well, the minutes point to the fact like this, right? And they said it very clearly. A majority of the participants judged that one more increase in the target federal funds rate at a future meeting would be likely appropriate, while some judged that no further rate hike or rate increases would be warranted. So it's kind of split, right? So now what? Okay, great. We got that information split. So now what do we do? Well, you can point to the swift rise in long-term rates as having done some of the work on behalf of the Fed, leaving them the ability to potentially sit tight, meaning pause again in November. Fed Governor Chris Waller once again said it clearly yesterday at a conference in Park City, Utah. Financial markets are tightening up and they're doing some of the work for us. We are in a position where we kind of can watch and see what happens on rates. Okay, so that's kind of clear with him saying he's okay to pause. Well, I guess you have to say that the financial markets and the bond markets had, been doing the work, right? We saw the 2s, the 10s, and the 30 years rise swiftly over the last couple of weeks. Talk of a 5% 10-year was all the rage, right? This after the 30-year also kissed and pierced 5% last week. But then we get the conflict in the Middle East, right, over the weekend. And this now in its 6th day with no end in sight. And that has caused a flight to safety, sending bond prices up, causing yields to go down. The 2-year this morning is yielding 4.99%. That's down from 5.15% last week. The 10-year is even more dramatic, right? This morning, that bond is yielding 4.56% versus down 30 basis points since the high last week of 4.87, a 6% decline in the yield. Now, this as U.S. and global investors are finding safety in the U.S. Treasury market, right, by buying up bonds. The TLT, the 20-year Treasury bond ETF, rising more than 5% since Monday. But remember, the bond market has gotten slammed this year, right? It was down, that ETF was down more than 16% year to date coming into the week. So you could also argue that maybe it was just overdone to the downside, providing an opportunity for investors. In any case, the move up in bond prices that caused yields to decline. So now what? Does this mean that the Fed is going to have to reconsider a November move just because yields have come down? They have not stayed elevated. Now, recall yesterday we discussed how the Fed has worked very hard to convince the market and investors that they were leaving rates unchanged, that they were going to pause, right? It's called jawboning. It's an attempt to persuade or pressure the idea by force of one's position of authority. So if you're a Fed member, you can jawbone the markets, right? They had most of the regional Fed presidents and Fed governors all pushing that narrative. They even leaked the story to who? Nikki at the Wall Street Journal. The real outlier, the one that didn't appear to be convinced, though, was Michelle Bowman. She remains steadfast in the idea that while we have made progress, she is not yet convinced that the Fed is done raising rates. And so she firmly stands on the side of another rate increase. But she's almost a lone wolf now. In the end, what they decided was that if the bond market did the work, then they didn't have to. So now we have to see what the bond market's going to do. A decline in bond yields is not going to help. Yet, Fed fund futures bets on whether we get a hike or not soared yesterday, right? They're now putting only a 9% chance on a rate hike. Also means a 91% chance that there's going to be no hike in November. And they put a 28% chance of a rate hike in December, meaning that there's a 72% chance that investors are not expecting a rate hike in December as well, right? And that is up sharply from what yesterday morning's bet was, right? And that leaves today's CPI report, which is out at 8:30. Now, the expectation is for month-over-month and year-over-year numbers to be lower than last month. But after yesterday's stronger PPI report, it's difficult to see how today's CPI report could be anything but hotter, right? And if it's weaker, it's going to cause many to question the data. Okay, let's be clear. If it costs the producer more to produce at the producer level, the logic this tells you that the producers are going to do what? They're going to pass on those higher costs to who? To the consumer. And the CPI is all about who? The consumer. Now, that's unless the producers choose to eat those higher costs and not pass them on. But come on, really? Does anyone really think that producers are going to risk squeezing their margins only to watch investors all run for the exits? I don't think so. All you have to do is look what Pepsi reported, right? And again, what Delta reported. They both beat on the top and bottom lines. They were giddy to tell us how the recent price increases helped to carry them through. Well, of course they didn't. The recent price increases allowed them to keep their margins strong. In fact, they pushed prices up so much that the extra is what fell to the bottom line, Kamish. And this is not rocket science, right? This is just simple math. This isn't even college level calculus math. This is simple second grade math. For example, if it costs $3 to make something and they charge you $5, then $2 flows to the bottom line, right? 5 minus 3. But if it costs you now $4, which is a 33% increase, and they raise the price to $7, that's a 40% increase. Guess what happens? Do the math. It's not that complicated. $3 falls to the bottom line, 7 minus 4. And that equates to $1 more in the bottom line, or a 50% increase. And that increase protects their margins, and that protects them. That protection allows them to release this statement. So yesterday, Pepsi came out and said, driven by strong results in business momentum, the company raised its core constant currency earnings per share view for 2023. Of course they did. Of course they raised their core constant currency earnings per share because they raised their prices, or they shrunk their containers and kept the prices the same, which is really a hidden increase, right? Think of it as a tax on the consumer, which is exactly what inflation is, right? It's a tax on you and me and our ability to buy, right? Because everything becomes more expensive. But whatever, because it is what it is. We can have this argument all day long if we want. Now, stocks initially rallied strongly out of the gate yesterday morning, even as the PPI came in hotter. The S&P, as I suggested in yesterday's note, ran right up to the trend line, 43.85 at resistance, and it failed. At the end of the day, the Dow ended up 65 points, but this was after being up more than 200 points early in the morning. The S&P was up 18, leaving it just 10 points below that trend line. The Nasdaq added 97 points, the Russell was up 3, and the transports gained 50. This as investors digested the stronger PPI report and parsed through the Fed minutes. The big tech boys outperformed, and part of that is because they've been under some pressure recently as investors have used them as ATMs, taking cash out just to raise cash. Amazon up 1.8, Google up 1.9, Microsoft up 1.3%, Nvidia up 2.2%, Meta up 1.8%, right? All rebounding nicely. At the end of the day, it was consumer staples, energy, and healthcare, all defensive names that ended the day lower, right? While real estate gained 2.2%, utilities up 1.6%, tech up 1%, communications up 0.9%, basic materials, consumer discretionary both gained about 0.4%, with financials carrying up the rear, rising just 0.2%. All very interesting. And the utilities one is also interesting because that's typically a defensive play as well. The contra trades ended lower, right? The VIX, the fear index, which had surged higher in the last couple of weeks, fell by 5.5% yesterday to end the day at 1609 and is now down 24% since last week. Thus, the move up in stocks. The VIX is a bit lower this morning, and that's giving life to U.S. futures. Dow futures are up 115, S&P's up 16, and that's if this holds, right? And if it does hold, we're going to bust right up and through resistance. The NASDAQ is up 60, the Russell's ahead by 14. Clearly, the market is thinking two things this morning. First, that the CPI is not going to surprise and come in weaker. And second, that the Fed is absolutely pausing. Those are the only two reasons that we would see the market act like it is today, right? Higher yesterday, higher again today, higher earlier this week. My caution is that we have not seen the end of sticky inflation or higher interest rates, which means don't let anything surprise you. Stick to your plan, right? That's what this is all about. Delta Airlines, like I said, they just announced early this morning, and guess what they did? They also beat. Profit jumped by 60%. Of course it did. Did you see what they did to prices? Oh boy. Delta now wants $550 to fly from West Palm Beach to New York City, and that only gets you a reservation. Then you got to select a seat. That costs you another $80. Then you got to pay for a bag if you're checking one. That's another $35. And if you want to pre-board or get on early, you got to pay another $25. So that takes you to $700, and you still have to pay taxes on top of that, right? And don't forget, they are not flying wide-body planes to and from. They're flying 3x3s, right? And they barely any leg room because now they've squeezed another row in there, allowing them to squeeze more people into a smaller container. How's that working for you? And this stock is quoted up 2% in the pre-market on the back of that earnings report. Oil this morning is trading up 60 cents at 84.11 after falling yesterday on the back of the API report, right? It showed that U.S. crude oil stockpiles swelled by almost 13 million barrels, which was about 12.5 million barrels more than the expectation of 500,000, right? Now, refining maintenance, right? Shutdowns in refineries, though, is being cited as the reason for the outsized build in those crude inventories. Gas inventories also rose by 3.6 million barrels, which is better than the 800 expected that they thought. So that's suggesting, at least they tell us it's suggesting, that consumers are at their pain point and that they're cutting back on consumption, something I do not for 1 minute believe at all. I just don't. Today we're going to get data from the EIA, and let's see what they have to say. Now, we know how the story can change from Monday to Tuesday. On Monday, we're bullish. On Tuesday, we're bearish. On Wednesday, we're bullish. On Thursday, we're bearish. I mean, it's ridiculous. Gold continues to push higher, right? Think of the safe haven asset. This morning, it's up $7 at $18.94 an ounce. Think geopolitical concerns and a weaker dollar on the back of the Fed commentary suggesting another pause. We're only 26 points below trendline resistance in gold. The dollar index is now trading at 105.66, down 20 cents from yesterday. And likely going a bit lower on the pause commentary. Remember, trendline support for the dollar is 104.62, and I suggested we are going to test that over the next couple of weeks if, in fact, the Fed maintains that narrative. Now, European markets this morning are all higher. ECB officials, like Fed officials, are all singing the same tune, right? Rate hikes have peaked, which then puts them in pause mode, and that's what's sending those markets higher. All the markets across the region are up by more than 0.6%. Wow, this is great. All this noise in New York City is up doing this. I think it's wonderful. Anyway, the S&P closed at 43.76, up 18 points yesterday. And there's a real possibility that we're going to kiss and pierce trendline resistance at 43.85 right on the opening. We have to see what the CPI report says at 8:30 this morning, though. If we push up and through, and then we're going to push up and through the short-term resistance at 44.10, then it's only a matter of time before we test the August highs of 4,500-ish, and so I suspect that this continues to be the story that we will test the 4,500-ish, but I still think that we're going to end the year right around 4,500-ish. So I think there's going to be lots of churn between now and the end of the year, which again only supports my point as a long-term investor. Stop with the short-term trading mentality. Put on your investor mindset and stick to your plan. Don't try to pick tops and bottoms. Build a strong, diversified portfolio. Okay, so what do we have for dinner tonight? Well, we need something tangy and spicy. So what did I come up with? Once again, why not? The linguine puttanesca. This is such a simple dish to make, but it has all that tang and spice in it. Many of you know the dish originated in Naples, right? Which itself is a tangy, spicy place, and is today really a staple of any Neapolitan household, right? It's made from tomatoes, black olives or Kalamata olives, capers, anchovies, onions, garlic, oregano, parsley, right? It's easy to make, and it has an interesting history. Geez, cops all over the place. I wonder what's going on. Anyway, whatever its origin, it's a great dish that's easy to prepare. It's spicy and tangy and vibrant, right? It's vibrant. That's really important. And it's an appropriate description for really what's going on in the markets today. So you want to start with 3 crushed garlic cloves. You want to saute that in olive oil for 3 or 4 minutes. You know, you want to get it nice and soft and fragrant, right? Don't let it burn. Next, you're going to add the diced white onion and the diced and minced anchovies. Now, the anchovies melt, so don't worry about that. And saute that for another 5 minutes or so. As they cook, they melt away, so you don't even see them, right? At that point, then you're going to add 1 28-ounce cans of kitchen-ready crushed tomatoes. Not puree, crushed tomatoes. That's it, nothing fancy. You're going to add about 1/4 of a can of water to that. You're going to let it, bring it up to a boil, and then turn it down, let it simmer for 10 minutes or so. Next, you're going to add the capers, the oregano, the pepper, the chopped Italian parsley, and the rough chopped pitted Kalamata olives or pitted black olives. One or the other, don't mix them. Now, no need to add salt as the anchovies are salty enough, but you can taste it. If you want to add a little bit, go ahead. If you like more of a bite, you can add red pepper flakes at this point. Cover it and then let it simmer, right? In the meantime, you've brought a pot of salted water to a rolling boil. You're going to add the linguine to that pot. Don't use capellini or angela. It's too thin and it just clumps up around, right? Let that cook until al dente, maybe 8 minutes or so. You know the routine. Remove it. Right, using the tongs, remove the pasta, put it right in the saute pan with the puttanesca sauce and mix it all around until it's well coated and fragrant. Now look, if the pasta sucks up the sauce, what do? You take a ladle of the pasta water, which is also considered the tears of the gods, and you add it to the saute pan just to keep it moist. You do not want to make it soupy. Make sure you understand that. Always have fresh grated Parmigiano cheese on the table for your guests. You can never have enough fresh grated Parmigiano cheese in any event. Look, it's going to be a busy day here in Manhattan. You can hear all the noise. The sun is out. It's going to be a nice day. In any event, till tomorrow, take good care.